Alright, so you have some extra cash and you're thinking about investing, but if you're new to this, it can feel like you're trying to read a foreign language. No worries, I got you. This is the ultimate beginner's guide to investing in this year. I'll break it down into 5 easy sections. Part 1, why invest and not save. Part 2, what you should invest in as a beginner. Part 3, when and how much to invest. Part 4, I'll walk you through a live stock purchase step by step. And Part 5, investing strategies for beginners. Alright, let's get into this. Part 1. So investing isn't just for Wall Street pros, it's for anyone who wants their money to work instead of just sitting around and losing value. Let's say that you have an extra $1,000. So what's the plan? You could spend it on something fun, or stash it under your pillow, or just let it sit in your savings account. But here's the problem. Inflation is eating away at your money. That $1,000 won't be worth the same in a few years. Prices are ultimately going to go up and your money's buying power is going to be less. Think about it. Have you ever noticed that your caramel frappuccino that used to be $5 is now almost around $8 or $9? So that's pretty much inflation in action, and the smartest move that you can do is to invest that cash so that it grows rather than it shrinking. Now, growing your money isn't magic, it's math, and there are 2 key ways this happens. First, when you buy a stock, you own a piece of a company. Take Nvidia for example. If Nvidia crushes it, designs and sells more graphics cards, launches a new product, and rakes in more profits, its value is also going to rise. Since you own a piece of Nvidia, your investments are also going to go up too. And that's pretty simple, right? The second way is through compound interest, which Albert Einstein calls the 8th wonder of the world. This is when your money makes money and that money makes even more money. It's kind of like a snowball rolling down a hill, and it gets bigger and bigger over time. Let's say that you invest $1,000 a month with a 10% return. After around 6 years or so, you're gonna hit around $100,000. But here's where it gets crazy. The next $100,000 takes less than 4 years, then less than 3 years, then less than 2 years. And by the time you have a $1 million portfolio, your portfolio is going to grow $100,000 and more every year or so. This is why it's so important to get started with investing as early and often as possible. Part 2. Alright, now you're on board with this whole investing thing, but the next big question is, what do you actually invest in? Many beginners make the mistake of chasing whatever stocks are hot at the moment. And really, this is a bad idea. Just because a stock crushed it last year doesn't mean that it's going to do the same next year. Let me prove this to you. Remember a couple years back, there were stocks like BlackBerry and Kodak? Well, at their peak, their shares were worth around $145 and $90 respectively. And then when they crashed, their shares dropped all the way down to $10 and $1 respectively. If you invested based on past success, you would have lost a lot of money. So what's the better move? It's really through index funds. When you're investing in index funds, you're basically investing in a whole basket of stocks rather than just one stock. There's less stress and less risk and more potential for long-term growth. And even Warren Buffett, one of the best investors in the world, says that most people should be investing in index funds. And if it's good enough for him, it's going to be good enough for me. Investing in an index fund is one of the easiest ways to grow wealth without stressing over every stock pick. Even Jack Bogle, the founder of Vanguard, said, "Don't look for the needle in the haystack, just buy the entire haystack." And that's exactly what an index fund does. It gives you exposure to the entire market instead of just trying to pick the winners. So what exactly does an index fund mean? Well, the simplest way to break it down is by looking at the 2 words separately: index and fund. An index is just a list of companies. So for example, the S&P 500 is simply a list of the top 500 companies in the United States. And this includes Apple, Microsoft, and Tesla. A fund is just a collection of money pulled from investors, people like you and me, and that money is used to buy assets, in this case, stocks. So when I say invest in an index fund, I'm basically saying that we're investing in a little bit of each company in this entire index. Okay, so you get to diversify, but what's the next big advantage of investing in an index fund? Well, you get to lower your risk. Instead of putting all your money into one stock and hoping it takes off, you own a piece of hundreds of companies, reducing the chances of losing everything if one stock crashes. You can think of it as putting your eggs or your very small eggs in many different baskets. If one company struggles, it barely affects you because you still have hundreds of other companies carrying the weight. Okay, so let me show you a real world example of what an index fund looks like so you can see what you'd be investing in. So for this example, let's take a look at one of my favorite index funds, or an ETF, an exchange traded fund. This is called SPLG, which tracks the S&P 500. So when I buy into this ETF, I'm basically investing in all of the biggest companies in the world without having to buy each stock individually. This automatically lets me invest in companies like Microsoft, Nvidia, Tesla, Visa, and Home Depot. So when you invest in this ETF, how do you actually know which companies you're investing in? Well, it's pretty simple. You can actually check the portfolio section in the fund's holding. So if you take a look at SPLG, Apple makes up around 7% of this fund, Microsoft is around 6%, and Nvidia is also around 6%. Another ETF that I like is QQQ, which is an ETF that tracks the Nasdaq 100, or the top technology companies in the United States. I like it because I get to sell covered calls against my shares, and QQQ is one of the most traded ETFs in the world right now, meaning that volume and liquidity is very, very high. However, if you're someone who just wants to invest for the long term, you don't want to complicate things with covered calls, then you can just invest in ETFs like SPLG, VOO, SPY, or IVV. These are all ETFs that pretty much do the same thing. They track the S&P 500, but they're just from different companies. Now, something else that you want to consider before investing in your first ETF is to look at the expense ratio. So what's the expense ratio? Basically, these are fees that cover the cost of managing the fund. These fees go towards administrative costs and keeping the fund running. So let's say that there's a fund that charges a 1% expense ratio. If you invest $11,000, you basically would be paying $110 per year in fees, which are automatically deducted from your investments. Generally speaking, you should be looking for index funds or ETFs that have an expense ratio below 0.5%. So here are my recommendations for picking ETFs. First, you want to pick an ETF that tracks, say, the S&P 500 or whatever index that you want to invest in. Second, you want to pick an ETF that is within your price range. And third, you want to pick an ETF with a low expense ratio. Let's say that you want to start off by investing in the S&P 500, which on average gives a 7 to 12% annual return. Now, this doesn't mean that every year it goes up 7 to 12%. Some years it could go down 20%, and other years it could also go up 20%. But in the long term, if you were to stretch out that x-axis, the S&P 500 usually gives around 7 to 12% a year. Part 3. Alright, so now that you understand what to invest in, the next big question is, when do you actually start investing? Every time someone asks me this, I usually take them through a simple 2-step checklist. And if you can check these off, that means that you're ready to start investing. The first question is, do you have high interest debt over 7 to 12%? If you do, you should pay that off before investing a single dollar. Paying off debt is like getting a guaranteed return. Usually, if someone promises you a guaranteed profit, they're probably scamming you. But in this case, it's actually true. Think about it this way. The stock market averages around a 10% return. But if you're paying 25% interest on credit card debt, paying that off first is like getting a guaranteed 25% return. It's the easiest win that you'll ever get. Say you owe $10,000 on a credit card with a 25% interest rate. That's $2,500 annually, money that automatically gets deducted from your bank because you have to pay off that interest. And this credit card debt acts kind of like a leak in your finances, where if you're trying to fill up your gas tank and there's this massive hole in it, you want to fill up that hole before you put in more gas. Instead of throwing $10,000 into the stock market, if you use it to pay off your debt, you're instantly saving $2,500 with zero risk. That's kind of like making $2,500 in the stock market without any risk, and these types of returns are very hard to find. The second question is, do you have a 3 to 6 month emergency fund? An emergency fund is like a safety net just in case life gives you unexpected expenses. If your car breaks down, you have a flat tire, or maybe if you lose a job, you want to make sure that you have an emergency fund. And if you don't have an emergency fund, you might end up relying on a credit card, or even worse, selling your investments at a bad time, which then compounds your losses. So before you put in any money into the stock market, make sure that you check off these 2 boxes. Your high interest debt is gone, and you have an emergency fund. Now let's talk about how much money you should actually invest. A lot of people think they need thousands of dollars to get started, when in reality, you could start just by investing $1. Now with that said, your returns are going to depend on how much you invest. Smaller investments are going to lead to smaller returns, and bigger investments are going to lead to bigger returns. If you invest $10 and the stock goes up 10%, you make $1. And it's not exactly life-changing. But if you invested $50,000 and got the same 10% gain, that's $5,000, which is a bigger difference. So my rule of thumb, only invest money you don't need for the next several years. So if you're saving for a house and you need that money within 1 to 2 years, the stock market isn't the place for it. Because the stock market is going to have volatility and it's going to go up and down like a roller coaster in the short term, and there's no real way to predict it with absolute certainty. And if anyone claims that they know exactly where the stock market's going to go in the short term, they're lying to you because no one can predict the future. Part 4. All right, let's go step by step on how to buy your first stock. And to make this practical, I'll walk you through an actual trade. When it comes to investing, you have two main options for brokerage accounts. First, you have your retirement accounts like your 401k and your Roth IRA. These accounts have major tax benefits, but the catch is that you can't pull that money out before 59.5 without any penalties. If you want more flexibility, you can then consider opening up a TBA or a taxable brokerage account. With all these different types of accounts, you can open them up with companies like Fidelity, Schwab, Vanguard, or if you're out of the US, you can even look into Interactive Brokers. So what's the trade-off between investing in a Roth IRA versus a TBA or a taxable brokerage account? Well, in a nutshell, with a TBA, you can contribute as much money as you want and take out as much money as you want compared to a Roth IRA where there are going to be some contribution limits. However, with a TBA, just like the name implies, you are going to be taxed, right? Because it's called a taxable brokerage account. However, with a Roth IRA, all your money is going to be taxed and penalty-free at the age of 59.5. So basically, a Roth IRA has more tax advantages. Okay, so let's go to Vanguard, Schwab, or Fidelity, and let's open an account. And you can open any of these accounts here, like a Roth IRA or a brokerage account. Once you click on it, it's going to take you to a form, and you have to fill out some of your important information like your name, address, birthday, social security number, and all of this really takes around 5 minutes. Once you get your account, you can then go to your dashboard and then click on transfer, so this way you can link your bank account and then deposit money from your bank account into your brokerage account. Next, you can go back to your dashboard and go to the little magnifying glass and then search for the stock or ETF that you want to invest in. So for this example, I'm going to type in SCHD. You can see that if you want to buy one share of this ETF, it's going to cost around $20-something. Let's say that you want to buy one share, you can type in the number 1, and then you can set this as a market order rather than a limit order, just to keep things simple. And then you can go all the way to the bottom and then click on buy, and that's pretty much it. Now, if you want to check what you're actually investing in, you can go to a website like Yahoo Finance and go to the holdings section. You can see that within this ETF, there are companies like Visa, Coca-Cola, Home Depot, Cisco, and Pfizer. And that's it. Congratulations, you made your first stock purchase and you are now officially an investor. Now look, if you're still not too sure on how to get started with investing, I highly recommend that you join my beginner's investing class. I just opened up some spots and I can walk you through this entire process step by step, and you can ask me your beginner's investing questions in the live stream. I'll leave the invite link down below. Part 5, let's look at some investing tips for beginners. When should you sell your stocks, or do you just keep holding on to them? For beginners, my thought process is simple. Think long term. This means that you ideally want to hold on to your investments for at least 3 to 5 years or even longer. Honestly, whenever you buy a stock or an ETF, you just want to buy it, hold on to it, and forget about it. And if you watch my video, 12 micro habits that made me rich, you'll know that every month a portion of my income is automatically put into my investment accounts. I then use that money to buy a couple of shares of my favorite ETFs every single month, even when the stock market temporarily drops. Because the natural reaction for many people is to panic and sell before they lose more. And this is what everyone calls panic selling. And panic selling is precisely how most people lose money in the stock market. So let me show you something that proves why selling in a panic is one of the worst mistakes you can make if you're serious about building wealth. Let's take a look at SPY or SPY, which is an S&P 500 ETF that tracks the S&P 500. Let's take a look at a chart of SPY and say we rewind all the way back to the early 2000s. Imagine that you decided to invest in the stock market back then, where maybe you bought a share back in October 2007 for $154. And your plan was to hold on to it and let it grow over several years. But then what happens? Boom, the 2008 financial crisis hits and the entire stock market crashes. At this point, a lot of people start to panic. They sell everything because they're scared. And honestly, I get it. It's terrifying to see your portfolio drop and so much red on your screen. But if you zoom out and use logic instead of fear, history tells us something important. that markets recover. And here's the key. You haven't lost anything unless you actually sell. SPY dropped around $154 to around $73. But if you don't sell, you still own that one share. You only lose money if you sell at a loss. But if you fast forward to say February 2013, take a look at SPY. It's now around $150 per share, and now you've broken even. But if you keep holding on to your ETF, by 2015, SPY is up around $229. And if you fast forward to 2018, you can see that SPY is now $300 per share, and you basically doubled your money. And if you keep holding, you keep ignoring the news, you keep ignoring the noise, and you trust the process, over time, you're going to learn that the stock market always wins. And now if you take a look at SPY, SPY is around $500 to $600 per share, which is almost a 4x return. And all you had to do was patiently wait. So here's the takeaway. It doesn't matter what happens day to day. If you invest for the long term, the stock market rewards patience. And I get it, emotions take over when you're in the moment and logic takes a backseat. But I say, take a pause and take a deep breath. Because if you look at any long-term S&P 500 chart, you'll see the same pattern, and that the stock market trends up over time. And whenever the stock market drops, they're going to feel huge in the moment, but in the long term, most likely you're not even going to remember them. Studies have shown that if you miss just the 10 best days in the stock market, your returns can be cut by over half. This means that if you put $100,000 into the stock market and left it alone, over time it could grow to, say, over $200,000. But if you panic and jump in and out, you might only end up with around $144,000. Markets don't rise gradually, they surge when you least expect it. And if you miss those surges, your returns are going to get ruined. This is why it's always better to have time in the markets rather than timing the markets. Again, if you want to learn more about investing, sign up for my beginner's investing class and I'll help you get started. I left the link down below and I'll see you in class.